Joins us. Gautam, good morning. Thank you for joining us. How much more to go? How much more pain is there? Do you think the global pain has just about started, or we are nearing the end of the pain?
So global, clearly our house view is that we will see a lot more pain, specifically in the fourth quarter this year and even first quarter next year, because the negative impulse from the increased trade war worries, which we have seen over the last couple of months, will be felt in numbers and data points in those quarters rather than now. So that outlook is definitely not looking rosy as far as the Indian macro is concerned. Locally, obviously, the key delta would be the scale as well as timing of the policy response, because without a policy response, it's difficult to put a timeline about when the Indian local macro cycle steadies and bottoms out.
Okay, so Gautam, if your view is that globally the worst is not behind us, then what should one do with their portfolio? Get out, because if one gets out, you can still save 10-15% of your total capital, because you're not sounding bullish, you're sounding bearish. If your underlying thought is that the worst of the pain is not behind us, that means worst of the price action is also not behind us. If you think prices will decline, should one sell and go away?
So risk reward clearly is still not favorable. So let's put it that way, because there are always so many moving parts globally and locally, and investors have different time perspectives. Some look at 1 quarter performance, some look at 1 year, some slightly longer term. But any way we look at it, if you look at the risk reward, what is the fair value, the upside downside scenarios, at these levels, risk reward is definitely not attractive for people to put in more money. For people looking at slightly longer term, beyond next 1 year, etc., market is trading at fair valuation, keeping in mind the last few years of valuation ranges. So that's the way I'd put it. If you're looking at short term, we clearly see some more downside potential. Again, will depend on how quickly the policymakers respond. Longer term, the market valuations are much more supportive at these levels.
The policymakers have responded enough, and whatever they could have done, they have done. Now, the easy answer, the easy thing would have been that compromise on the fiscal deficit and smart spending. They've not done that, but in terms of recognition, in terms of giving whatever they can, given the current challenges which are local and global, and also on the fiscal side, you think we've heard the most of the policy measures, and now nothing less left is there, nothing is left in the tank?
No, I don't think so. I think there's a lot more likely policy response over the course of the next few months or few weeks from both the government as well as RBI. Again, if you just step back and look at, say, RBI, the liquidity infusion from RBI, it's only over the last 3 months we have seen the systemic liquidity reaching surplus, and it takes time to transmit it through the entire economy. So the liquidity surplus didn't happen till 3-4 months back, while the NBFC crisis hit us more than about a year back. Even the rate cuts they have done till now, the real interest rates are still very high. So can the RBI cut rates more aggressively to bring down real rates, at least comparable to other EM countries? Absolutely. So there's a lot more room for them to cut rates more aggressively. Even on the fiscal side, what we are seeing right now in the economy, in our view, is neither necessarily structural or cyclical, but also over the last 3-4 months, reflective of a negative feedback loop or a classic vicious cycle, where the slowdown impact of NBFCs on autos and property is feeding into the rest of the economy. And the negative feedback loop has also become one of narrative post the budget in the economy and the markets. And these negative feedback loops, as we have seen globally and in India, typically are broken only if we see a policy response. Otherwise, they can have their own dynamic. So the fiscal stimulus or fiscal intervention is also something which will not roll out despite the lack of fiscal space. Question is how much, when. That's a call for policymakers to take. How much they want to look at short-term growth, how much they want to bear the cost of any such short-term stimulus. That's a call they have to take. But scope and space for fiscal stimulus for the short term, given the negative feedback loop, I think the government does have a case. Is it going to be meaningful? We don't know yet.
Gautam, when it comes to the financials, private banks, that's where you seem to be leaning toward. Are you seeing that optical recovery in the earnings for financials, largely on account of the NPL cycle? What is, your case for betting on this space?
So yes, that's one of the arguments for betting on private financials is the recovery in earnings because of the NPL cycle turning. But beyond that, also a couple of other points to make there on private financials. One is the next cycle is likely to be much more supportive and amenable to private banks or private financials with retail liability franchise, vis-a-vis the last few years where clearly the wholesale funded banks and NBFCs did better. So that's another reason to be positive on the retail liability driven private financials. And lastly, if you look at the next 5 years odd, the competitive environment in general in the financial system could also be supportive of the business mix, etc. they have. So private financials is not just about the optical turnaround in NPL cycle, but also the next 3-year, 5-year cycle also being supportive of them.
Wondering then, Gautam, what's the right approach right now? How is it that you capital protect? Do you actually profit take from some of those blue chip large caps or mega caps, whatever you choose to call them, and profit take out of there? Or do you start deploying money between the beaten down mid and small caps and just stay put for another 1 year?
So our view would be still underweight small and mid caps. That view has been there since early last year, and we still haven't changed that view. While the relative valuations are looking more attractive now, they are not in absolute terms attractive, or risk reward is that attractive. Ideally, you'd want to buy small mid caps at 30% odd discount, where you get attractive risk reward. And some of the individual quality names of the small mid caps haven't really de-rated much. So small mid caps still underweight. On the large caps, you have to be selective because it's not going to be a broad-based macro stabilization slash recovery as we can see in the next quarter or two. It will be pockets, so you have to look at individual stocks and sectors. So retail financials backed by retail liability franchise look good. Oil and gas, property, power utilities, these are the sectors we would bank on in terms of recommending an overweight position right now, or even looking at capital protection.
So Gautam, if somebody has to invest the UBS way, you are saying that sell and go away.
Not at all. So again, if you're looking at a risk reward perspective, our fair value for Nifty is around 11,000, while the upside downside scenarios which we have based on various moving parts suggest the risk reward to buy at these levels doesn't exist. So from a longer term perspective, we are not at levels where I would recommend sell and go away. If markets were at around 12,000 levels, then yes, that would be the call. At these levels, if you're looking at a short term perspective and you want to be a short term trader, then yes, there is downside potential in the near term, but then you're also presuming that the policy action in the next few weeks will continue to underwhelm market expectations and hopes, which is a very, very big call to make and not a call we would want to make easily. So that's why in this kind of environment, you have to keep the risk reward framework in mind and your investment time horizon in mind.
All right, Gautam, appreciate your time and thank you for joining us.